Imagine you are standing on the sunlit deck of the largest and most advanced cruise ship ever built by human hands. The engines beneath you are roaring with the unbelievable, unprecedented power of artificial intelligence, pushing the vessel forward at breakneck speeds. Everyone on deck is cheering, holding up their glasses and celebrating the fastest journey in human history, while the stock market breaks record after record. But deep down in the dark control room, a very different and terrifying story is unfolding. A few critical gauges on the bridge, particularly those monitoring the traditional banking sector, and global financial institutions are flashing a violent warning red, unseen by the celebrating passengers. Pirate ships representing massive global cyber threats are silently surrounding the vessel in the water. And the crew, the everyday workers who actually keep the ship running, are quietly whispering among themselves, wondering if they will even have a job tomorrow, or if the new automated engines will simply replace them all. This is not a science fiction movie plot. This is the exact state of our global economy right at this very moment. We are caught in a massive, invisible collision between unprecedented technological wealth and terrifying systemic fragility. Hello, this is WarmInsight. Today we're going to talk about the hidden collision between artificial intelligence dominance and the crumbling foundations of our traditional financial system. Leaving a like and subscribing is a huge help to us. Let us start by looking at the incredible towering giants of our modern era, which we call big tech. Companies like AMD, Supermicrocomputer, and Arista Networks are no longer just businesses. They are practically digital nation-states in terms of their staggering wealth and global influence. Every time the stock market closes, these tech giants seem to report financial numbers that completely defy the laws of economic gravity. But what is really driving this massive explosion of wealth? It is the modern gold rush of artificial intelligence. To truly understand the mechanics of this, we need to travel back in time, to the middle of the 19th century during the Great California Gold Rush. Back then, it was not the everyday people digging in the dirt for gold who made the most consistent, reliable fortunes. The real winners were the merchants who sold the shovels, the heavy pickaxes, and the durable denim jeans to the desperate miners. Today, the global economy is in a brand new digital gold rush. Artificial intelligence is the gold. But the companies manufacturing the highly complex computer chips, the massive cooling systems, and the giant data centers, they are the ones selling the digital pickaxes. And right now, they are selling them at an absolute premium to everyone, desperate to strike it rich. But there is a very dangerous psychological trap hidden inside this boom. It is a trap called the herd mentality. Right now, everyone is desperately chasing these perceived winners. They see tech stocks making massive after-hours jumps, and they experience intense FOMO, which stands for the fear of missing out. Think of FOMO like being at a high school dance, where everyone in the room suddenly runs to one side of the gymnasium. Even if you have absolutely no idea what is happening over there, you feel a primal, overwhelming biological urge to run over there too, just so you are not left out of the group. This powerful herd mentality often completely blinds every day investors to the underlying structural risks of the economy. Because while the tech profits look absolutely amazing on the surface, they are frequently pumped up by what financial experts call inflated valuations. An inflated valuation is like buying a basic paper cup of black coffee for $50, just because a famous celebrity held it on television. The coffee itself is absolutely not worth $50. But the massive societal hype makes people willing to pay that ridiculous, illogical price. Historically, we saw this exact same mass euphoria during the massive dot-com bubble in the late 1990s. Back then, any random company that simply added .com to its name or put an E in front of its product saw its stock price skyrocket overnight, regardless of whether they actually made a single penny of real profit. Let us look at a famous example from that era, like Pets.com. This was a company that sold dog food over the early internet. They spent millions of dollars on a massive marketing campaign, including a multi-million-dollar Super Bowl commercial featuring a talking sock puppet. The public went completely wild and the stock soared into the stratosphere. But there was a fatal mathematical flaw in their underlying business model. It literally cost them more money in postage to ship a heavy bag of dog food than they actually made selling it. The underlying business math was completely broken from day one. But in the wild euphoria of the herd mentality, absolutely nobody cared. Investors were blinded by the magic word internet. Within less than a year, gravity took hold, the company went completely bankrupt, and the stock crashed to absolute zero, wiping out the life savings of everyone who blindly bought into the hype. Today's smart investors, the contrarians of Wall Street, are looking at this new AI boom and asking a very difficult, unpopular question. Are these astronomical profits genuine, or are they just a digital mirage, fueled by temporary hype and bloated stakes in unproven private startups? But the financial hype is only the bright, shiny side of the coin. If we flip that coin over, we find something deeply unsettling that threatens everyone. The CEO of Anthropic, one of the leading artificial intelligence companies in the entire world, recently issued a chilling public warning. He stated that the rapid evolution of AI is simultaneously exposing thousands of cybersecurity vulnerabilities, creating a massive moment of danger that requires urgent global action. Let us break down what a systemic cyber vulnerability actually means. For your daily life, imagine you live in a highly secure fortress. You have thick steel doors, heavy deadbolt locks, and a state-of-the-art alarm system. You feel entirely safe. Now imagine an invisible thief invades the distant factory that makes the keys to every single door in the world, and secretly changes the physical shape of the master key. Suddenly, your fortress is not safe at all, and you do not even know it. Your vulnerability is systemic because the hidden flaw is baked into the very foundational system you rely on to protect you. Throughout modern history, cyber threats have evolved from simple, annoying pranks to devastating weapons of mass global disruption. Think back to the terrifying Stuxnet virus in the year 2010. It was a highly complex, malicious computer worm that specifically targeted Iran's nuclear facilities, physically spinning and destroying the heavy mechanical centrifuges used to enrich uranium. It definitively proved to the world that a piece of invisible digital code could cause catastrophic physical destruction in the real physical world. Or let us look at the devastating WannaCry ransomware attack that swept across the globe in 2017. This was a piece of malicious software that locked up crucial computer files and demanded ransom payment in digital Bitcoin to unlock them. It did not just target rich corporations. It completely crippled the National Health Service in the United Kingdom. Emergency life-saving operations were abruptly canceled. Ambulances were diverted away from hospitals, and critical patient medical records were entirely inaccessible. Human lives were put at direct physical risk, simply because of a digital vulnerability, and that attack was carried out with relatively primitive tools. Compared to what is freely available today, now multiply that threat by a factor of 1,000. AI is not just a friendly tool for writing faster emails or generating funny images. It is a highly capable engine that can write malicious, destructive code at lightning speed, constantly probing the digital walls of our global banks, our electrical power grids, and our local hospitals, looking for a single microscopic crack in the armor. This is the terrifying dual edge of artificial intelligence. It drives unprecedented economic efficiency and scientific innovation, but simultaneously creates brand new massive vectors for systemic global risk. The institutions that manage smart money deeply understand this dark reality. They are not just blindly buying tech stocks hoping for the best. They are heavily, aggressively investing billions of dollars into cybersecurity defense solutions because they know that in a near-future world, run by highly intelligent automated machines, the most valuable and rare commodity of all will be complete digital resilience. While the tech world is flying high and fighting digital wars, the traditional financial sector is showing very deep structural signs of stress. Imagine the global banking system as the hidden plumbing inside, a giant 100-story skyscraper. When the water pressure is fine and the pipes are working, absolutely nobody thinks about them. But when those pipes start to loudly groan and leak, the entire building and everyone inside it is in immediate danger. Recently, HSBC, one of the largest and most established banking institutions in the world, reported a significant miss on their first quarter pre-tax profit. They missed their financial targets by billions of dollars. Why exactly did this happen? It was largely due to what the complex banking industry calls higher expected credit losses. Let us translate that complex jargon into everyday simple terms. Imagine you are generous and you lend $100 to 10 of your different friends. Normally, you expect maybe one friend to be a little late, paying you back because life happens. But suddenly, the local economy gets very tough. Groceries are way more expensive. Gasoline prices are through the roof. Now, instead of just one friend, 3 or 4 friends call you in a panic and say they cannot pay you back at all. That is an expected credit loss. When giant global banks start reporting that they expect a massive wave of everyday people and small businesses to default on their loans, it is a massive, flashing red warning sign for the entire global economy. It tells us the ugly truth that despite the shiny tech headlines, the everyday consumer is struggling under immense financial pressure. We have seen exactly what happens when the global banking system ignores these flashing warning signs. We only need to look back to the horrific 2008 financial crisis. To really grasp this, we need to understand a term called subprime mortgages. Back then, banks simply got way too greedy. They ran out of highly qualified, responsible people to lend money to. So they started freely lending hundreds of thousands of dollars to people with terrible credit histories, no verifiable income, and no assets whatsoever. These were actually called ninja loans. No income, no job, no assets. The banks then bundled these incredibly toxic garbage loans together, magically labeled them as completely safe investments, using complex financial engineering, and sold them to unsuspecting investors and pension funds around the entire world. It was a massive, fragile house of cards, built entirely on a foundation of loose sand. When the adjustable interest rates on those mortgages finally went up, and the monthly payments skyrocketed for those borrowers, millions of people simply walked away from their homes. The sand washed away, and the global banking system almost completely imploded, plunging the entire world into the Great Recession. Today, we are seeing a different but equally dangerous kind of pressure. Traditional banks are facing agile, aggressive disruptors. Financial technology firms or fintech companies are swooping in, offering much faster, cheaper, and more digital-friendly services right on your smartphone. When a small, nimble fintech firm starts legally buying up traditional banking assets, it triggers massive regulatory alarm bells in Washington, because the old rigid banking rules were not written for this new, blistering speed of digital finance. Adding intense fuel to this banking pressure is the highly complex world of global interest rates. Right now, you might see bright advertisements for certificates of deposit or CDs, offering up to a 4.1% annual yield. A CD is basically a financial promise to the bank. You give them your hard-earned money for a set period of time, and they promise to pay you a guaranteed steady interest rate. For cautious savers, this sounds absolutely fantastic. But on the exact flip side of the economy, we see massive banking institutions like Chase heavily promoting aggressive mortgage rate sales, desperately trying to convince people to borrow huge sums of money to buy homes. Why are there such violently mixed signals in the market? It is because central banks around the world are currently trapped in a terrifying high wire, balancing act without a safety net. They are actively fighting a ruthless monster called inflation. Inflation is the invisible silent thief that slowly steals the purchasing power of your money while you sleep. If a loaf of bread costs $1 today and $2 next year, your money is essentially worth half as much as it used to be. Let us examine the most extreme historical example of this to understand the true fear. Look at the Weimar Republic in Germany during the 1920s. After World War I, the German government decided to simply print massive, endless amounts of paper money to pay off its staggering war debts. The result was hyperinflation. The currency lost its value so rapidly that everyday people had to take literal wheelbarrows full of cash just to buy a single loaf of bread from the bakery. Workers demanded to be paid twice a day so they could run to the store on their lunch break before prices doubled again by the late afternoon. Children played with giant stacks of completely worthless money, like building blocks in the street. While we are absolutely not facing Weimar levels of hyperinflation today, central bankers are utterly terrified of that monster waking up. They know that once inflation, psychology becomes deeply embedded in the minds of a society. It is incredibly difficult to eradicate. If people believe prices will be higher tomorrow, they rush out to buy things today, creating a self-fulfilling prophecy of endless rising prices. To fight this invisible thief, central banks raise interest rates. Think of the economy as a giant, fast-moving highway, and interest rates as the posted speed limit. When the economy is moving way too fast and prices are rising too quickly, the central bank violently raises the speed limit to slow everyone down. Making it much more expensive to borrow money cools off corporate spending. This drastic strategy has deep historical roots. In the late 1970s and early 1980s, the United States faced terrible runaway inflation. The chairman of the Federal Reserve, a man named Paul Volcker, had to raise interest rates to absolutely punishing levels, reaching over 20%. It was a brutal, bitter medicine that caused a severe, painful economic recession, but it successfully killed the inflation monster. Today, modern central banks are officially signaling a higher for longer rate environment. They are deeply afraid that if they lower interest rates too soon to make people happy, the inflation monster will come roaring back with a vengeance. This means that for the foreseeable future, borrowing money to buy a house or start a small business will remain very expensive. This puts immense crushing pressure on the profit margins for traditional banks, which is exactly why they are desperately trying to stimulate consumer demand with targeted flashy promotions. But what does all of this incredibly complex macroeconomic maneuvering mean for the everyday hardworking person? This brings us to perhaps the most alarming and sobering data point of all, the prediction markets. A prediction market is essentially a digital platform where global traders place real financial bets on the outcome of future real-world events. It is a highly accurate way of crowdsourcing the collective intelligence and the deep-hidden fears of thousands of smart people. And right now, these prediction markets are flashing a terrifying red signal. Traders are forecasting that by the year 2026, there will be over 447,000 jobs permanently lost in the technology sector alone. This creates a massive jarring disconnect in the media. On one hand, wealthy Wall Street analysts are shouting from the rooftops, telling everyone to buy tech stocks and praising the glorious artificial intelligence revolution. On the other hand, the actual people on the ground are betting their real money that this exact same revolution will lead to catastrophic, permanent job displacement. To truly understand this fear, we must look back to the massive disruption of the Industrial Revolution. In the 19th century, when the mechanical power loom was invented, it completely automated the incredibly difficult job of weaving cloth. A group of skilled English textile workers known as the Luddites suddenly realized that these giant machines were going to permanently destroy their livelihoods. In a desperate protest, they physically smashed the machines and burned down the factories. They were not inherently anti-technology. They were simply terrified of their families, starving to death because their highly specialized lifetime skills were suddenly rendered entirely worthless overnight. Another perfect historical parallel is the turn of the 20th century in New York City. In 1898, the bustling streets of New York were completely dominated by horses and horse-drawn carriages. There was an entire massive, bustling industry built around this mode of transport. There were blacksmiths, carriage makers, stable hands, and street sweepers who just cleaned up the manure. If you were a highly skilled master buggy whip maker, you probably thought your job was incredibly secure for life. But then Henry Ford and the affordable motorized automobile arrived. Within exactly 13 short years, the horses almost completely vanished from the streets of New York. An entire complex ecosystem of jobs was obliterated almost overnight. The buggy whip makers did not do anything wrong. Their specific skills simply became entirely irrelevant to the future. Today, we are facing a modern, digital version of this exact same terrifying dynamic. Rapid artificial intelligence adoption is leading to a massive, brutal re-evaluation of long-term employment stability. The fear is absolutely not that machines will turn evil and shoot lasers like in a science fiction movie. The real fear is that artificial intelligence will quietly and efficiently automate the daily tasks of well-paid accountants, legal researchers, computer coders, and middle managers, much faster than society can possibly reskill those millions of workers. If hundreds of thousands of high-paying, comfortable jobs suddenly vanish into thin air, it directly leads to massively depressed consumer demand. People without jobs do not buy expensive new cars. They do not go on lavish vacations. And they certainly do not buy the digital products made by the tech companies that just fired them. This is what we call the institutional bear scenario. A bleak world where rapid tech adoption creates incredible, unimaginable wealth for a tiny microscopic few, but triggers widespread painful economic stagnation for the vast majority of the population. And as if all of this was not complicated enough, we must also factor in the massive, shifting geopolitical realignments happening across the globe right now. Let us look at a fascinating real-world example of this. Global drug makers, the massive pharmaceutical companies that produce the essential medicines, keeping millions of people alive, are suddenly rushing in a panic to boost their physical manufacturing. presence inside the borders of the United States. Why are they suddenly doing this? It is a direct, fearful response to looming global tariff threats and rising geopolitical tension between superpowers. To understand this shift, we need to truly understand the modern global supply chain. Imagine a massive, highly complex global assembly line stretching around the planet. For decades, the conventional business wisdom was to simply build products wherever human labor was the absolute cheapest. The raw materials might be mined from the earth in Africa. The electronic components might be assembled in massive factories in Asia, and the final shiny products sold on shelves in North America or Europe. This era of hyperglobalization brought consumer costs down drastically for everyone, but it secretly created an incredibly fragile, brittle system. We saw this hidden fragility exposed in real time during the massive global pandemic, when factories suddenly shut down on the other side of the world. Suddenly, everyday people in the United States could not buy basic toilet paper or simple computer chips. Giant automobile manufacturers had to completely halt production and leave half-built cars sitting in lots simply because they were desperately waiting for a single $10 microchip from a factory thousands of miles away across an ocean. Now the terrified world is actively shifting from hyperglobalization to a new era of regionalization. Massive countries and giant multinational corporations are suddenly prioritizing safety, security, and resilience over pure cost efficiency. This new trend is called de-risking. They want critical vital industries, like advanced semiconductor manufacturing and life-saving pharmaceuticals, located safely within their own borders, or inside the borders of closely allied friendly nations. This massive geopolitical fragmentation means that cross-border technological innovation might significantly slow down. It means that the golden era of incredibly cheap consumer goods, fueled by frictionless global trade, might be permanently coming to an end. This massive shift adds yet another heavy layer of stubborn inflationary pressure to the global economy, making the central bank's job of controlling everyday prices even more incredibly difficult and dangerous. So how exactly do the absolute titans of finance, the massive institutional giants, navigate this incredibly treacherous shifting landscape? They absolutely do not panic, and they never put all their golden eggs in one single basket. They use a highly disciplined mathematical strategy called asset allocation. The current smart money institutional playbook suggests a very specific ratio for survival: 55% in growth stocks, 35% in safe assets, and 10% in pure liquid cash. Let us break down what this actually means using a simple, relatable analogy. Imagine you are the ruler managing a large ancient kingdom. Your stocks are your armored knights. They are aggressive, they ride out and conquer new wealthy territory, and they bring back the absolute highest rewards for the kingdom. But they also face the absolute highest risks of dying in battle. You definitely want the majority of your army to be strong knights, which is exactly why 55% is allocated to stocks. You want aggressive exposure to broad-based technology funds, capturing the massive upside of the artificial intelligence boom before it is too late. But you also absolutely do not want all your knights wearing the exact same type of armor. You must strategically diversify into quality, dividend-paying stocks or essential healthcare funds. These are your reliable defensive plays. People will literally always need basic medicine, and reliable, boring companies that share their steady profits through dividends provide a soft cushion when the high-flying tech stocks inevitably stumble and fall. Next, we have the 35% allocated to safe assets. These are the thick stone walls of your castle. These might be boring government bonds or high-yield certificates of deposit. They are absolutely not going to conquer new lands or make you instantly rich, but they are mathematically guaranteed to protect what you have already built. In a chaotic world of systemic cyber risks and crumbling banking fragility, you desperately need strong, thick walls. Finally, the 10% kept in pure cash. This is your emergency reserve locked deep in the castle vault. In the financial world, cash is oxygen. When the stock market suddenly panics and great valuable assets suddenly go on sale at massive fire sale discounts, the people holding cash are the only ones who can swoop in, like kings, and buy them up for pennies on the dollar. This mathematically balanced approach is absolutely crucial for long-term survival. When you compare United States investment versus international exposure, the smart money knows that the U.S. currently heavily holds the crown because of its massive dominance in tech, but completely ignoring the rest of the world is a fatal, arrogant mistake. Developed international markets and rapidly growing emerging markets offer incredible long-term value. Think of emerging markets like planting a tiny seed in highly fertile, untouched soil. It carries significantly more risk because the local weather might be completely unpredictable. But the long-term growth potential is absolutely massive. When hundreds of millions of people in an emerging market suddenly get their very first smartphone, open their first digital bank account, and buy their first refrigerator, the resulting economic explosion is absolutely massive, offering a highly valuable mathematical hedge against the specific banking problems currently plaguing the Western world. For the everyday individual desperately trying to survive these massive global mechanics, the most powerful single tool in your entire financial arsenal is a boring concept called dollar cost averaging. Let us explain this simply so anyone can master it. Imagine you want to buy a lifetime supply of your absolute favorite coffee beans, but the global price fluctuates wildly every single day. One day it is $10 a bag, the next day it shoots up to $20. If you try to aggressively guess the exact perfect day to buy all your beans at once, you will likely drive yourself completely crazy and probably guess horribly wrong. Instead, you decide to simply mathematically buy exactly one bag of coffee every single Monday morning, regardless of the price tag. When the price is painfully high, your $20 mathematically buys fewer beans. When the price completely crashes and goes on sale, your $20 mathematically buys a massive mountain of beans. Over a long period of time, your average cost magically smooths out perfectly. That is dollar cost averaging. You consistently mechanically invest a fixed amount of money on a strict set schedule. It entirely completely removes the destructive emotion from investing. It mathematically prevents you from panic selling when the evening news is terrifying, and it stops you from FOMO buying when everyone on social media is bragging about their fake gains. This mechanical strategy, combined with regular portfolio rebalancing, is the ultimate financial shield. Let us illustrate rebalancing with a casino analogy. Although smart investing is fundamentally completely different from gambling, imagine you walk into a shiny casino and sit at a table. You start with exactly $100 in chips. Through sheer blind luck, you win several hands in a row, and suddenly you have $500 stacked in front of you. The highly emotional amateur gambler gets incredibly greedy. They foolishly think they are totally invincible, so they leave all $500 on the table and keep betting aggressively, eventually losing every single penny when their luck inevitably turns sour. The cold, disciplined professional player does something completely different. When they hit $500, they physically take $400 completely off the table, put it deep in their pocket, and confidently walk away, securing their initial investment and a massive guaranteed profit. They only keep playing with the original $100. Portfolio rebalancing is the exact same cold discipline. When your artificial intelligence stocks double in value, they suddenly mathematically make up way too much of your total portfolio, exposing you to massive catastrophic risk if the tech sector suddenly crashes. Rebalancing forces you to take those chips off the table. You mechanically sell a portion of your massive winners, locking in those real gains, and you use that cash to buy the boring, safe assets that have temporarily dropped in price. It feels completely emotionally counterintuitive. Flawed human psychology desperately wants to hold on to the exciting winners forever and sell the boring losers in a blind panic. But the cold, unforgiving math of wealth creation demands the exact opposite behavior. You must mechanically consistently prune your portfolio to ensure that absolutely no single sector, whether it is high, flying big tech, traditional failing banking, or volatile international markets, can ever completely destroy your hard-earned financial foundation. We are currently living through a massive generational turning point, a defining moment in global history that will absolutely be written about in economics textbooks centuries from now. Just like the monumental shift from horse-drawn carriages to motorized automobiles, or the massive global explosion of the early internet, the current artificial intelligence revolution is aggressively destroying old rigid paradigms and rapidly forging completely new realities in the ever-shifting, unpredictable currents of the global economy. True, lasting wealth is built not by desperately chasing every single exciting wave, but by deeply understanding the massive, invisible tides moving beneath the surface. It requires cold patience, strict discipline, and a stubborn refusal to ever be swept away. by the dangerous emotional herd mentality. You must be fully financially prepared for the coming violent storms of banking, sector stress, and global geopolitical tension, while intelligently keeping your sails angled to catch the incredibly powerful winds of genuine technological innovation. We have covered a truly massive amount of vital ground today, exploring the terrifying dual edges of technology, the deeply hidden risks quietly cracking our traditional banks, and the psychological, emotional traps that silently destroy generational wealth. We couldn't fit all the deep dive details and practical strategies into this video,